Question 1. General insurance concepts. Which of the following statements about utmost good faith in insurance contracts is correct? A. It means both parties to the contract must fully disclose all material facts that affect the contract. B. It applies only to the insured, who must disclose all relevant information to the insurer. C. It applies only to the insurer, who must fully disclose all information to the insured. D. It allows the insurer to refuse a claim even if the insured has not concealed material facts. Answer A. It means both parties to the contract must fully disclose all material facts that affect the contract. Explanation. Utmost good faith, also known as Jura mi fideo, is a fundamental principle in insurance contracts. It requires that both the insurer and the insured must disclose all material facts to each other. If one party withholds information that would affect the decision of the other party, the contract may be voided. This ensures fairness and transparency in the transaction. The principle applies to all types of insurance contracts and is especially important during the underwriting process. A failure to disclose material facts can result in claims being denied. Question 2. Life insurance. Mr. Williams, a 45-year-old individual, purchased a whole life insurance policy with a $200,000 face value. He recently realized that he needs to borrow money for a business venture. Can Mr. Williams use the policy's cash value, and if so, how does it impact his death benefit? A. Mr. Williams can borrow from the policy's cash value, and any amount borrowed will reduce the death benefit. B. Mr. Williams cannot borrow from whole life policy. Only term policies offer such an option. C. Borrowing from the cash value does not impact the death benefit, as it is only loan. D. Mr. Williams must pay penalty if he borrows from the cash value, but the death benefit remains unchanged. Answer A. Mr. Williams can borrow from the policy's cash value, and any amount borrowed will reduce the death benefit. Explanation. Whole life insurance policies accumulate cash value over time. This cash value can be borrowed against by the policyholder, often at low interest rate. However, any amount borrowed will be deducted from the policy's death benefit if not repaid before the insured's death. The insurer will subtract the outstanding loan balance and interest from the face value of the policy. It's essential for Mr. Williams to understand that borrowing against the policy reduces the death benefit and may also affect the policy's overall performance. Question 3. Scenario-based question on casualty insurance. Sarah, the owner of a small retail store, recently bought a commercial general liability CGL policy. After a customer slipped on a wet floor in her store, the customer filed a lawsuit for medical expenses and lost wages. Sarah's policy includes coverage for bodily injury, but there is $5,000 deductible. Sarah is concerned about the potential out-of-pocket cost. What should Sarah expect from her CGL policy? A CGL policy will cover all of the customer's medical expenses, but Sarah will need to pay the $5,000 deductible before the insurer covers any costs. B. The CGL policy will cover the entire $5,000 deductible as it applies to medical expenses under bodily injury coverage. C. The CGL policy will pay for the lawsuit costs, but only if the customer is proven to be at fault. D. The CGL policy will cover both the medical expenses and lost wages without any deductible applying. Answer A. A CGL policy will cover all of the customer's medical expenses, but Sarah will need to pay the $5,000 deductible before the insurer covers any costs. Explanation. In this scenario, Sarah's commercial general liability CGL policy provides coverage for bodily injury claims, such as the one made by the customer who slipped on the wet floor. However, most insurance policies include deductible that the policyholder must pay before the insurer begins covering the costs. In this case, the $5,000 deductible applies to the claim. This means Sarah will need to pay the first $5,000 of the costs associated with the claim, after which the insurer will cover the remaining expenses up to the limit specified in the policy. It's important to note that the CGL policy covers medical expenses, legal defense, and other related costs, but not lost wages unless specified by the policy. The policyholder's out-of-pocket expense is usually the deductible. Question 4. Property insurance. Which of the following statements is true about replacement cost and actual cash value received in property insurance? A. Replacement cost covers the cost to replace property without any deduction for depreciation, while SEV subtracts depreciation from the replacement cost. B. Replacement cost is always cheaper than SEV because it does not account for depreciation. C. SEV provides more coverage than replacement cost because it compensates for the depreciation of property. D. CV is not the common method used in property insurance, while replacement cost is the standard approach. Answer A. Replacement cost covers the cost to replace property without any deduction for depreciation, while SEV subtracts depreciation from the replacement cost. Explanation. Replacement cost RC insurance provides coverage for the full cost of replacing property with no deduction for depreciation. This ensures that the policyholder can replace damaged or lost property with new items of similar kind and quality. On the other hand, actual cash value SEV coverage considers depreciation, which means it reimburses the policyholder for the depreciated value of the property, often resulting in a lower payout than the replacement cost. SEV is a more cost-effective option for insurers, but may leave policyholders with higher out-of-pocket costs to replace property fully. Question 5. Casualty insurance. Which of the following coverages would be included in a commercial general liability (CGL) policy for a business? A. Coverage for damage to the business's own property. B. Coverage for personal injuries to employees while at work. C. Coverage for bodily injury or property damage caused to third party. D. Coverage for damages to vehicles owned by the business. Answer C. Coverage for bodily injury or property damage caused to a third party. Explanation. Commercial general liability (CGL) policies provide coverage for a business in the event it is found liable for bodily injury or property damage caused to third parties. This includes coverage for incidents that occur on the business's premises or as a result of business operations. CGL policies do not cover damage to the business's own property. This would typically be covered under commercial property insurance, nor do they cover personal injuries to employees, which would be covered under workers' compensation insurance. Additionally, vehicle damage would be covered under business auto insurance or CGL policy. Question 6. Health insurance. Which of the following provisions is typically included in an HMO health maintenance organization plan? A. Coverage for out-of-network services is always included. B. The insured must choose a primary care physician (PCP) to coordinate all care. C. The insured can see any specialist without a referral from a primary care physician. D. Coverage for prescription medications is never included. Answer B. The insured must choose a primary care physician (PCP) to coordinate all care. Explanation. Health maintenance organizations (HMOs) are a type of managed care plan that requires insured individuals to select a primary care physician (PCP) who serves as the point of contact for all medical care. The PCP coordinates referrals to specialists, and non-emergency care typically requires a referral from the EMO. Plans are known for offering lower premiums but more restrictions on care and access to specialists compared to other plans like PPOS. Coverage for out-of-network services is usually limited, and prescription medications are typically included in HMO plans. The details may vary depending on the specific policy. Question 7. Risk management. Which of the following risk management strategies involves transferring the financial responsibility of a potential risk to another party? A. Risk avoidance. B. Risk retention. C. Risk control. D. Risk transfer. Answer D. Risk transfer. Explanation. Risk transfer is the strategy of shifting the financial burden of a potential risk to another party, usually through insurance. By purchasing insurance, a business or individual transfers the financial responsibility of losses from a specific risk, such as property damage, liability, or health-related issues, to the insurer. Risk avoidance involves taking steps to eliminate the risk entirely. Risk retention means accepting the risk and bearing the cost if it occurs, and risk control involves reducing the likelihood or impact of a risk happening. Question 8. Life insurance. Which of the following best describes a beneficiary in a life insurance policy? A. The individual or entity that is responsible for paying the premiums. B. The policyholder who owns the life insurance policy. C. The individual or entity designated to receive the death benefit upon the insured's death. D. The individual who is underwritten for the policy and determines the terms. Answer C. The individual or entity designated to receive the death benefit upon the insured's death. Explanation. The beneficiary of life insurance policy is the person or entity designated to receive the death benefit when the insured individual passes away. The policyholder, who may be the same person as the insured, designates the beneficiary at the time the policy is purchased. It is critical that the policyholder clearly names the beneficiary to ensure that the death benefit is paid out to the intended party. The beneficiary can be person, business, or charitable organization, and they are typically entitled to the entire death benefit or specified portion of it. Question 9. Pennsylvania insurance regulations. In Pennsylvania, which of the following would not result in a penalty for an insurance producer? A. Failing to complete required continuing education hours by the renewal deadline. B. Committing an act of insurance fraud. C. Providing false information on a license application. D. Selling a policy without informing the client of its exclusions. Answer D. Selling a policy without informing the client of its exclusions. Explanation: selling a policy without informing the client of its exclusions is generally considered unethical but may not directly lead to a penalty unless it involves misrepresentation or fraudulent activity. In contrast, the other options, failing to complete continuing education, committing fraud, or providing false information, directly violate Pennsylvania's insurance laws and can lead to penalties such as fines, suspension, or revocation of the producer's license. Insurance producers in Pennsylvania are required to maintain ethical standards, complete continuing education, and avoid fraudulent activities to retain their licenses. Question 10. Insurance contracts and principles. Which of the following is a necessary element for a legally binding insurance contract? A. A mutual understanding of the premium rate between the insurer and the insured. B. The contract must be signed by both parties in the presence of a notary public. C. Both parties must agree to the terms and provide consideration. D. The insured must pass a medical examination before the contract is binding. Answer C. Both parties must agree to the terms and provide consideration. Explanation: for an insurance contract to be legally binding, it must meet the basic elements of any contract: offered acceptance and consideration. Both parties, the insurer and the insured, must agree to the terms of the contract acceptance, and there must be consideration, something of value exchanged. In the case of insurance, the insurer provides coverage in exchange for the payment of premiums. While a medical examination may be required for certain types of insurance, like life insurance, it is not a standard requirement for all contracts to be binding. A notary public is not required for an insurance contract to be legally valid. Question 11. Types of insurance entities. Which of the following describes a mutual insurance company? A company that issues stock to its shareholders in exchange for investment capital. B. A company where policyholders own the company and receive dividends based on the company's profitability. C. Company that specializes in providing health and life insurance products exclusively to government employees. D. Company that insures businesses against general liability risks and is organized as for-profit entity. Answer B. A company where policyholders own the company and receive dividends based on the company's profitability. Explanation: mutual insurance company is owned by its policyholders, who share in the profits of the company. When mutual company is profitable, it may pay dividends to its policyholders or reduce premiums for future coverage. This model differs from stock insurance companies, where shareholders own the company and profits are typically distributed to shareholders in the form of dividends rather than to policyholders. Mutual companies often focus on providing various types of coverage, including life, health, and property insurance. Question 12. Property insurance. Which of the following is covered under a standard homeowners insurance policy? HO3 in Pennsylvania. A. Flood damage to the home's foundation. B. Damage from an earthquake. C. Damage to personal property caused by fire. D. Maintenance-related water damage to plumbing. Answer C. Damage to personal property caused by a fire. Explanation: homeowners insurance policies, such as the HO3 policy, typically cover damages to personal property caused by specific perils like fire, theft, or vandalism. However, certain risks, such as floods and earthquakes, are not covered under a standard homeowners policy and would require separate coverage. Additionally, maintenance-related issues, such as water damage from plumbing problems, are not covered under a standard homeowners policy, as these are considered the homeowner's responsibility. Question 13. Casualty insurance. What does negligence refer to in a casualty insurance claim? A. Intentional actions that lead to damage or harm. B. The failure to take proper care, resulting in injury or damage to another party. C. An unforeseeable event that causes injury or damage. D. A violation of a law that leads to bodily injury or property damage. Answer B. A failure to take proper care, resulting in injury or damage to another party. Explanation: negligence refers to the failure to act with the level of care that a reasonably prudent person would exercise in a similar situation, leading to injury or damage to another party. It is a key concept in casualty insurance because it forms the basis for many claims, particularly in liability insurance. If a business or individual is negligent, they may be found liable for damages resulting from that negligence. Question 14. Life insurance. Which of the following describes the purpose of a rider in a life insurance policy? A. A rider is a separate policy that provides additional coverage for the policyholder's family members. B. A rider is an amendment to the policy that adds or modifies coverage. C. A rider is an endorsement to the policy that decreases the death benefit. D. A rider is a document issued by the insurer that specifies the premium payment schedule. Answer B. A rider is an amendment to the policy that adds or modifies coverage. Explanation. A rider is an additional provision added to a life insurance policy that alters the terms of the contract. Riders can provide extra benefits or modify the coverage, such as adding coverage for accidental death, critical illness, or a waiver of premium if the policyholder becomes disabled. Riders are customizable based on the policyholder's needs and are typically added for an additional cost. Question 15. Health insurance. Which of the following is true about pre-existing conditions under the Affordable Care Act in Pennsylvania? A. Insurers can deny coverage for pre-existing conditions. B. Insurers can charge higher premiums for individuals with pre-existing conditions. C. Insurers are prohibited from denying coverage or charging higher premiums based on pre-existing conditions. D. Pre-existing conditions are covered only after a waiting period of 12 months. Answer. C. Insurers are prohibited from denying coverage or charging higher premiums based on pre-existing conditions. Explanation. Under the Affordable Care Act, insurers are prohibited from denying coverage or charging higher premiums due to pre-existing conditions. This rule applies to all individual health insurance plans, ensuring that individuals with pre-existing health conditions have access to insurance coverage at the same rates as those without such conditions. This is a key provision of the ACA that promotes equitable access to healthcare. Question 16. Insurance contracts. Which of the following is required for an insurance contract to be considered legally enforceable? A. The policyholder must have an insurable interest in the subject of the insurance. B. The insurance company must issue the policy in writing. C. Both parties must sign the contract in the presence of a notary. D. The insurance policy must be approved by a state regulator. Answer A. The policyholder must have an insurable interest in the subject of the insurance. Explanation. For an insurance contract to be legally enforceable, the policyholder must have an insurable interest in the property or life being insured. Insurable interest means that the policyholder would suffer a financial loss or hardship if the insured event occurs. This is a fundamental requirement for all insurance contracts to prevent moral hazard and ensure that insurance is used for legitimate purposes, while written policies are standard notarization and state approval are not required for the contract to be legally binding. Question 17. Commercial insurance. Which of the following is typically covered by a commercial property insurance policy? A. Loss of business income due to a covered property loss. B. Legal fees associated with a third-party lawsuit. C. Medical expenses for employees injured on the job. D. Employee theft of company property. Answer A. Loss of business income due to a covered property loss. Explanation. Commercial property insurance typically covers physical damage to business property, but it can also provide coverage for business income loss due to a covered property loss, such as a fire or theft. This coverage is commonly referred to as business interruption insurance. Other types of insurance, such as workers' compensation insurance, cover employee injuries, and liability insurance covers legal fees associated with lawsuits. Employee theft is typically covered under a separate crime or fidelity bond policy. Question 18. Auto insurance. Which of the following types of coverage is required by law in Pennsylvania for all drivers? A. Comprehensive coverage. B. Collision coverage. C. Liability coverage. D. Personal injury protection. PIP. Answer C. Liability coverage. Explanation. In Pennsylvania, all drivers are required by law to carry liability insurance, which covers damages to other people's property and bodily injury in the event that the driver is at fault in an accident. While comprehensive and collision coverage are optional, liability insurance is mandatory for all vehicles on the road. Additionally, Pennsylvania requires personal injury protection PIP coverage, which covers medical expenses for the driver and passengers regardless of fault, but PIP is part of the mandatory coverage. Question 19. workers' compensation. Which of the following is typically covered under workers' compensation insurance in Pennsylvania? A. Injuries sustained while commuting to work. B. Injuries that occur due to an employee's own misconduct. C. Occupational diseases that arise out of the course of employment. D. Injuries resulting from self-inflicted accident. Answer: C. Occupational diseases that arise out of the course of employment. Explanation: workers' compensation insurance covers work-related injuries and illnesses, including occupational diseases that occur as a result of the nature of the job. However, injuries sustained while commuting to work, the commute rule, injuries resulting from an employee's own misconduct, and self-inflicted injuries are typically excluded from coverage under workers' compensation insurance. Workers' compensation is designed to provide financial support and medical benefits to employees who are injured or become ill as a result of their work activities. Question 20. Insurance regulations. Which of the following is a duty of an insurance producer in Pennsylvania? A. To provide insurance policies that have been pre-approved by the state regulator. B. To ensure that clients only purchase the most expensive insurance plans available. C. To accurately explain policy terms and conditions to clients. D. To act as the insurance company's representative in legal disputes. Answer: C. To accurately explain policy terms and conditions to clients. Explanation: an insurance producer agent has a duty to provide clear and accurate information to clients regarding the terms and conditions of the insurance policies they offer. Producers must ensure that clients fully understand the coverage options and exclusions in the policy. Insurance producers are also expected to provide ethical and professional services, but are not responsible for ensuring that policies are pre-approved by the state regulator or for representing the insurance company in legal disputes. Question 21. Life insurance. What is the primary purpose of a contestability period in a life insurance policy? A. To allow the insurer to cancel the policy after it is issued if the policyholder's health improves. B. To allow the insurer to investigate and deny claims made within the first 2 years if the policyholder misrepresented information. C. To ensure the insurer can provide additional coverage for certain pre-existing conditions. D. To allow the policyholder to change beneficiaries without the insurer's approval. Answer: B. To allow the insurer to investigate and deny claims made within the first 2 years if the policyholder misrepresented information. Explanation: the contestability period is typically the first 2 years of a life insurance policy, during which the insurer has the right to investigate and deny claims if the policyholder provided false or misleading information on the application. This period allows the insurer to ensure that the policyholder did not intentionally misrepresent their health or other aspects of their application. After the contestability period ends, the insurer generally cannot contest a claim except in cases of fraud. Question 22. Property insurance. Which of the following perils is generally excluded from coverage under a standard homeowner's insurance policy? A. Fire. B. Theft. C. Earthquake. D. Windstorm. Answer: C. Earthquake. Explanation: a standard homeowner's insurance policy typically excludes coverage for earthquakes and may require a separate endorsement or policy to cover earthquake damage. Commonly covered perils include fire, theft, and windstorm. Earthquake coverage is usually purchased separately due to the high cost and potential damage associated with such events. Question 23. Commercial insurance. A business owner has a commercial property policy that includes coverage for inventory, equipment, and real property. The policy excludes coverage for damages caused by a flood. Which of the following actions should the business owner take to ensure coverage for flood damage? A. File a claim under the standard commercial property policy. B. Purchase additional coverage through the National Flood Insurance Program (NFIP). C. Wait for the insurer to provide flood coverage automatically. D. Adjust the policy's terms to include flood damage. Answer: B. Purchase additional coverage through the National Flood Insurance Program (NFIP). Explanation: standard commercial property policies do not cover flood damage, so the business owner must purchase additional coverage through the National Flood Insurance Program (NFIP) to protect against flood risks. Flood insurance is a separate policy designed specifically to address these types of losses and is not automatically included in standard property coverage. Question 24. Life insurance in Pennsylvania. Which of the following is a required feature of all life insurance policies? A. A grace period for premium payments. B. A provision that allows the insurer to cancel the policy for any reason. C. A waiver of premium for accidental death. D. A requirement that the policyholder be at least 60 years old to purchase the policy. Answer A. A grace period for premium payments. Explanation. In Pennsylvania, as well as in most states, all life insurance policies must include a grace period for premium payments. This grace period allows the policyholder extra time, typically 30 days, to pay the premium after it is due without losing coverage. The other options listed, such as automatic cancellation or age requirements, are not standard requirements for life insurance policies. Question 25. Health insurance. What is the primary difference between an HMO health maintenance organization and a PR preferred provider organization plan in terms of network flexibility? A. HMO plans allow members to see any specialist without a referral. B. PPO plans require members to choose a primary care physician. C. HMO plans require referrals to see specialists, while PPO plans do not. D. PPO plans do not cover out-of-network care under any circumstances. Answer E. HMO plans require referrals to see specialists, while PPO plans do not. Explanation. The key difference between HMO and PPO plans lies in the need for referrals. HMO plans typically require members to obtain a referral from their primary care physician before seeing a specialist. PPO plans, however, offer more flexibility, allowing members to see specialists and out-of-network providers without a referral, though out-of-network care may be subject to higher costs. Question 26. Disability insurance. Which of the following best describes the purpose of disability income insurance? A. To provide a lump sum payment to the insured upon diagnosis of a critical illness. B. To replace a portion of the insured's income if they are unable to work due to illness or injury. C. To provide coverage for medical expenses resulting from an accident. D. To pay for long-term care services if the insured becomes unable to perform daily activities. Answer B. To replace a portion of the insured's income if they are unable to work due to illness or injury. Explanation. Disability income insurance is designed to replace a portion of the insured's income if they are unable to work due to a covered illness or injury. This insurance helps the policyholder maintain their financial stability while they are unable to earn income. Other options, such as paying for medical expenses or long-term care, are covered by different types of insurance policies, e.g. health or long-term care insurance. Question 27. Insurance regulations. Which of the following is a requirement for an individual to be licensed as an insurance producer in Pennsylvania? A. The individual must be at least 25 years old. B. The individual must complete pre-licensing education courses. C. The individual must have a college degree in business administration. D. The individual must pass a written exam only without any continuing education requirements. Answer B. The individual must complete pre-licensing education courses. Explanation. In Pennsylvania, individuals must complete state-required pre-licensing education courses before they are eligible to sit for the insurance producer exam. After passing the exam, insurance producers are also required to complete continuing education to maintain their license. Age and educational requirements, such as having a college degree, are not part of the licensing process. Question 28. Auto insurance. Which of the following would most likely be covered under a personal auto policy (PAP) in Pennsylvania? A. Injury to the driver in a non-work-related accident while commuting. B. Damages to the insured vehicle due to flooding. C. Damage to another driver's vehicle in hit-and-run accident. D. Injury to passenger in the insured's vehicle caused by road hazard. Answer B. Damages to the insured vehicle due to flooding. Explanation. Under a personal auto policy (PAP) in Pennsylvania, comprehensive coverage typically covers damages to the insured vehicle due to non-collision events, including flooding, while liability coverage will address damages to other parties' vehicles. Flooding-related damages would be covered under comprehensive coverage, which is optional but commonly purchased. Injury to passengers or drivers from non-collision events, such as road hazards, may be covered under personal injury protection (PIP) or medical payments coverage, but the flooding specifically applies to the vehicle itself. Question 29. Workers' compensation in Pennsylvania. What is the primary benefit provided under workers' compensation insurance? A. Coverage for medical expenses related to a work-related injury or illness. B. A lump sum payment to family members of workers who die on the job. C. Legal defense for the employer if a worker sues for negligence. D. Income replacement for workers who are temporarily unable to work due to an injury. Answer A. Coverage for medical expenses related to a work-related injury or illness. Explanation. The primary benefit of workers' compensation insurance in Pennsylvania is to provide coverage for medical expenses related to work-related injuries or illnesses. Workers' compensation also provides income replacement and other benefits, including death benefits to family members in the event of a fatal injury. However, the primary focus is on medical treatment and rehabilitation for the injured worker. Question 30. Insurance ethics. An insurance producer in Pennsylvania is approached by a client who asks for an insurance policy with exaggerated coverage limits despite the client knowing the policy is unnecessary. What is the most ethical course of action for the producer? A. Provide the policy as requested to ensure the client is satisfied. B. Recommend a policy that provides appropriate coverage based on the client's actual needs. C. Suggest policy with the highest limits available to increase the producer's commission. D. Advise the client to purchase coverage from competitor who offers higher limits. Answer. B. Recommend a policy that provides appropriate coverage based on the client's actual needs. Explanation. The most ethical course of action for an insurance producer is to recommend policy that aligns with the client's actual needs. The producer should act in the best interest of the client, ensuring that the coverage is both appropriate and necessary, rather than simply seeking to satisfy the client's request for excessive coverage or maximizing commission.